Welcome back. Today we are going to talk about liability hedging portfolios, which are extremely meaningful and important building blocks in the design of investment solutions. Okay, let's first recognize that if you think about the investor standpoint and you think about what would be an investor's main concern, well, the investor's main concern is an unexpected increase in the present value of their liabilities relative to the value of the assets, right? So if they are about funded and the asset do something but the liability go down relative to the assets, then that leads to a reduction in the decrease in the funding ratio, which is bad news because it's going to lead to a decrease in the probability for the asset owner to meet their liabilities. Okay, so in a liability-driven context, in the presence of liabilities, the main concern is liability going up. This is very bad news. So the question is, what can we do to kind of immunize our portfolio with respect to this bad news? Well, this is exactly where liability hedging portfolios come handy. So a liability hedging portfolio, also known as LHP in short, also known in the individual investment context as a goal hedging portfolio or GHP. Remember, in individual money management, we don't talk about liabilities, we talk about goals. So the exact counterpart of a liability hedging portfolio is a goal hedging portfolio. Okay, so how do we define them? Well, we define them as portfolios that will pay off, that will give us cash flows, and these cash flows will match the date and nominal amount of those liability or goal payments. Okay, so in other words, the liability or goal hedging portfolio is an asset portfolio that behaves exactly like the liabilities that we are trying to immunize against, or that we are trying to protect, if you will. Now, how do we do this? Well, more often than not, we invest in nominal bonds or, sometimes real bonds, inflation-linked bonds, if the liabilities are inflation-linked. And we do so in such a way so as to match the cash flows on the liability side and on the asset side. Sometimes it turns out to be convenient to use derivatives, something like interest rate swaps, for example, or inflation swaps for inflation-linked liabilities. And some major investment banks are providing large asset owners with these derivative-based, investment solutions. And that comes, of course, at the cost of counterparty risk if you're using these over-the-counter derivatives. But otherwise, it's some kind of combination of cash and derivative fixed income instruments. Now, let's take a very simple example to try and understand what exactly is a liability portfolio or goal hedging portfolio looking like. I mean, what is it all about? So let's take the case of a very simple situation of an individual investor in this case. The current date is 2018. And let's assume that the investor is going to retire in 2035. Now, what we're going to assume is that this investor retiring in 2035, they are going to need replacement income cash flows for 20 years in retirement. In other words, I'm either assuming away longevity risk, and I'm assuming that people are going to live 20 years exactly in retirement and die, if you will, after 20 years in retirement. Or more realistically, I'm kind of assuming, if you will, that I'm only focusing on replacement need for 20 years in retirement, that maybe the consumption needs after those 20 years are covered by some kind of late life annuity or something else taking place. So I'm just going to focus for simplicity on the first 20 years in retirement. Now, in this context, clearly a standard bond with a maturity date, say 2040, is not going to be safe with respect to the retirement goal, right? Because that standard bond is going to start paying coupon payments on an annual or perhaps some semi-annual basis until maturity date. And then they're going to pay a big payment, which is face value being paid back to the investor. Now, this investor, by assumption, doesn't need money when they are still in accumulation, when they're still not retired. They're only going to need money when they retire. So in other words, the kind of bond payoff that they need, or the kind of bond cash flows that they need, are the kind of cash flow that would be paid by a goal hedging portfolio, which would be defined as a retirement bond. And we see the cash flows of this retirement bond here. It's a bond that's going to pay a series of constant or perhaps inflation-linked cash flows starting at retirement date, and not immediately, but only at retirement date. And when we are at retirement date, then we're going to be paying a series of cash flow. It's not coupon payment plus principal, just a series of replacement income cash flows. That's exactly suited to the needs of this investor. Now, when you think about this retirement bond, as we call them, retirement bond portfolios, it's fair to say that they are very volatile, right? Why? Well, because we're looking at long duration, long-term bond portfolios. So when interest rates go up and down, the change in value in these long-term bond portfolio goes down and up in a pretty massive way. And that's kind of what we see here. We see the volatility of this retirement bond over a long period of time. And this retirement bond is, of course, much more volatile than investing in cash, which has very little volatility, the rollover of cash, or invested in a short-term bond that moves up and down as a function of changes in interest rate. But because of a lower duration, the magnitude of the changes or the volatility is much smaller. Now, what we can see, though, is with the retirement bond, as we get closer to retirement date, duration decreases, and therefore the range of changes also decreases. Still, having said this, from this perspective, it seems that the retirement bond is pretty risky and much more risky than the standard bond and than cash. So in this case, cash looks like the safe asset. Well, you know what? This is simply because we're looking at things from the wrong perspective. From an asset-only perspective, yes, cash is safe. But from a long-term liability-driven investing, cash is extremely risky. So now we're switching to a new perspective where we're looking not at the value of the assets, but we're looking, or the return on the assets, but we're looking at the return on the funding ratio. If you're looking at the return on the funding ratio, by assumption, the retirement bond has no risk at all because the retirement bond perfectly replicates the liabilities, which in this case are defined as inflation-linked payments, replacement income payment for 20 years after retirement. Conversely, what we see is the short-term bond and even more so cash, they appear to be very risky simply because they don't move much, but the liabilities, if you look at the funding ratio, numerator doesn't move much, but the denominator of the funding ratio moves all over the place. Okay? So clearly we have to understand that what we call the safe asset is not something that can be defined in an absolute term. It's not something that can be defined in isolation from the investor. The safe asset is the asset that is safe with respect to the investor and more precisely with respect to the specific goal of the investor. There's another way to look at the situation, which is to look at the distribution of the terminal funding ratio. By terminal funding ratio, I mean funding ratio at retirement date. With cash, there's a wide range of outcomes in terms of funding ratio. And of course, on average, we are being short of meeting the target. When we invest in bonds, that's the same thing. Even if we start fully funded, we eventually lose ground because the liability portfolio behaves like a long-term bond, and because there's a bond risk premium, it tends to outperform the shorter-term bond. On the other hand, if we invest in the retirement bond portfolio or gold hedging portfolio, then there's no risk involved at all, 100% to stay at the initial funding ratio, which in this case, by assumption, was 100%. Now, in implementation, when and if feasible, we can buy pure discount bonds with maturity dates and nominal amounts matching the dates and amounts of those liability payments. Now, in practice, this is not very convenient because we don't have access to all of these pure discount bonds with all the needed maturities. Most of the bonds traded are actually coupon-paying bonds, and they may have slightly different maturities compared to our needs. So in this case, if we cannot do cash flow matching, perfect cash flow matching, what we are going to implement instead is approximate duration matching or factor exposure matching, more generally speaking. So what we're going to do is first, we are going to immunize the asset portfolio with respect to changes in interest rate. How can we do that? Well, you just have to hold in bond portfolio that has the exact same duration as the liability portfolio. If that's the case, and if there's a small decrease in interest rate, the liability value will go up, but the asset value, the bond portfolio on the asset side is going to go up by about the same amount because they have, by construction, the same duration. Now, we know that duration hedging is okay as long as it's like a first order approximation. So it's okay as long as we don't have a major shift in the yield curve. Well, we can go beyond duration. We can do duration convexity if we want to improve, kind of the performance of the hedging strategy. And we can also, if needed, seek to immunize the portfolio with respect to not only changes in the level of the yield curve, interest rates going down or up, but also changes in the shape of the yield curve. So for example, immunizing the asset portfolio with respect to a steepening move or a flattening move, if you will, in terms of changes in the shape of the yield curve that can steepen or flatten. Wrap up the discussion that we've had so far just emphasizes that for any investor endowed with liabilities, the main risk is an unexpected increase in liability value. Now, that's bad news unless you've done whatever it takes for the bond portfolio of some liability hedging portfolio on the asset side to increase exactly in parallel to the increase of the liability value. These safe portfolios are known as cash flow matching or duration matching bond portfolios, and these are the kind of techniques that we're using to design these liability or gold hedging portfolios.